There's a term you've probably heard, the circular economy. Reduce, reuse, recycle. Materials flowing back into the system instead of into a landfill. It's a genuinely good idea. This episode is about a different circular economy. This one doesn't recycle plastic. It recycles capital, and unlike the first one, nobody designed this version to save anything. Here's how it works in miniature. A chip maker invests billions in an AI company. The AI company uses that money to buy the chip maker's chips, routed through a cloud company the chip maker also happens to have a stake in. Each leg of that triangle books the transaction as revenue or backlog or growth. Zoom out, and it's the same roughly 10 companies showing up on multiple sides of deals that 2026 analyses now put at more than $800 billion combined. Footnote 1. This isn't a scandal exactly. Nobody's hiding what they're doing. It's in the earnings calls, the press releases, the SEC filings. It's also not obviously fine. This episode builds the actual mechanism from the ground up so that when, not if, one piece of it gets tested, you'll already know exactly what's holding it together. Start with the deals everyone's heard of because the structure is the point. In September 2025, NVIDIA announced a letter of intent to invest up to $100 billion in OpenAI, tied to OpenAI deploying at least 10 gigawatts of NVIDIA hardware. Footnote 2. As of NVIDIA's own November 2025 quarterly filing, the company noted there was no assurance the two sides would ever sign a definitive agreement, a caveat that barely moved NVIDIA's stock price. Footnote 3. Around the same time, AMD signed a roughly $200 billion arrangement with OpenAI that handed OpenAI warrants for up to 10% of AMD's equity. Footnote 4. And Oracle committed $300 billion in cloud infrastructure as the backbone of Stargate, a $500 billion joint venture with OpenAI and SoftBank. Footnote 5. Economists have a bland name for this pattern: vendor financing, a supplier helping fund the very customer buying its product. It isn't automatically fraudulent. Companies have used it for decades to lock in demand in a market where the product itself, in this case advanced chips, is still genuinely scarce. Footnote 6. The distinction that actually matters and that this episode keeps returning to is the one between vendor financing and round-tripping. Money that's really just relabeling itself as it passes through a loop of related companies, inflating how much of the total looks like real external demand. Footnote 7. Here's the second piece of the machine, and it's less visible than the headline deals: how the physical build-out, the actual data centers, gets paid for. Increasingly, it isn't paid for with cash off a company's own balance sheet. It's financed through a special purpose vehicle or SPV, a separate legal entity created specifically to own and build one data center, that borrows money against the projected cash flow from a long-term lease with a hyperscaler tenant rather than against the parent company's own creditworthiness. Footnote 8. This lets a developer reach 60 to 80% debt-to-cost leverage on the project while keeping most of that debt off the parent company's own books, a structure accountants call control without consolidation. The parent keeps effective control of the asset without the SPV's liabilities showing up on its own balance sheet. Footnote 9. Two live examples because the specificity is the argument. Oracle's Stargate data center in Abilene, Texas. The facility built specifically to serve OpenAI sits inside an SPV that received roughly $13 billion from Blue Owl Capital and JP Morgan, about $10 billion of it structured as debt. Footnote 10. Meta's Hyperion data center in Louisiana was financed through a separate SPV worth roughly $27 to $30 billion, with equity covering only about 8.5% of the total and debt covering the rest. Footnote 11. Here's what a deal like this mechanically is. A real building with real power connections financed almost entirely with borrowed money, owned by an entity built specifically so that money doesn't show up where a credit analyst looking at the parent company would normally think to check. Here's what it is not: illegal or even obviously irrational, given how real the underlying scarcity of advanced compute currently is. It is also not, on its own, proof that the demand these structures are betting on is actually there. Scale first. The six largest hyperscalers spent more than $800 billion combined on capital expenditure over the last 5 years, most of it on AI infrastructure. And that figure is projected to exceed $3 trillion between 2026 and 2030 alone. Footnote 12. Private credit's share of financing that build-out has gone from close to nothing to more than $200 billion in outstanding AI-related loans as of early 2026, with Morgan Stanley projecting an additional $800 billion over the next 2 years, a $1 trillion pipeline, flowing overwhelmingly through a small handful of private credit firms: Blackstone, Blue Owl Capital, Apollo, PIMCO, and BlackRock. Footnote 13. More than $120 billion in data center debt has migrated off hyperscaler balance sheets and onto these firms' books in under 18 months. Footnote 14. Now the contrasting pair, and this is the one that should actually give you pause. OpenAI, the company sitting at the center of most of these circular deals, filed a confidential S-1 with the SEC on June 8, 2026, ahead of a prospective IPO, reporting an annualized revenue run rate of roughly $25 billion by mid-year. Footnote 15. Set that against the company's own compute commitments, somewhere between $80 and $100 billion a year coming due over the next 5 years, and cumulative losses forecast at roughly $115 billion through 2029, with profitability now pushed into sometime in the 2030s, rather than the earlier 2029 estimate. Footnote 16. A company generating $25 billion is contractually on the hook for compute spending 3 to 4 times that size every year for years, financed substantially through the same circular deals and off-balance sheet debt this episode just walked through. Here's the human scale reframe, and it's the genuine surprise this section owes you. This debt isn't staying inside Silicon Valley. Regulatory changes have been steadily opening the door for private credit to flow into mutual funds and retirement products, and firms including BlackRock and PIMCO have been structuring exactly that kind of retail-facing exposure to AI infrastructure debt. Footnote 17. Which means a retiree's target date fund may now hold indirect exposure to the same debt financing a single company's bet on data center demand, without the retiree ever having heard the word Hyperion or Stargate. And the credit markets are starting to notice something. Meta, one of the most profitable companies in the world, saw the market price for insuring against its own debt default, its credit default swaps, hit a record level even as its core business remained healthy, a signal that bond investors are starting to price real risk into the specific debt tied to AI infrastructure, distinct from the company issuing it. Footnote 18. 4 things could plausibly constrain this, and each one runs into the same wall. Post-Enron accounting rules, the consolidation standards written specifically after 2001 to stop companies from hiding debt in off-balance sheet entities, are the most obvious candidate. They don't stop this because today's SPVs are reportedly built to comply with those very rules, achieving the same legal non-consolidation Enron was punished for, at a scale Enron's SPVs never approached. Footnote 19. Credit rating agencies are the second candidate, and they mostly rate each SPV's debt on the strength of its specific long-term lease with a hyperscaler tenant, which tells you almost nothing about how much total off-balance sheet leverage a company like Meta or Oracle has taken on across every SPV combined. Footnote 20. Bank regulators and stress tests are the third, and they mostly don't apply here at all. This lending happens through private credit funds, not banks, which is not a coincidence. Post-2008 capital rules specifically pushed this kind of leveraged, real estate-adjacent lending out of the regulated banking system in the first place. Footnote 21. And market discipline via bond and credit default swap pricing is the fourth, genuinely showing some signs of life, per Meta's CDS spike, but only after the aggregate exposure had already reached hundreds of billions, and largely invisible to the retail investors now holding pieces of it indirectly. Every door has a locked room behind it, and this one isn't hiding an incumbent's interest, and it isn't a founding bargain either. It's a relocated perimeter. The regulatory reforms written after 2008 to keep exactly this kind of risky leveraged lending out of the banking system succeeded, and simply pushed it next door into a less transparent, less consolidated, less visible part of the financial system, where it is now funding a build-out an order of magnitude larger than anything that prompted the original reform. There's a precedent for exactly this shape of story, and it's worth being specific about both where it matches and where it doesn't. In the late 1990s, telecom companies laid roughly 80 million miles of fiber optic cable, betting on internet traffic growth that took years longer to arrive than investors expected. 4 years after the bubble burst, by most retrospective estimates, somewhere between 85 and 95% of that fiber sat unused, dark fiber. Footnote 22. Here's where the parallel breaks down, and it's worth giving this its due honestly. Unlike dark fiber, today's data centers and power infrastructure have real, current value even if any single company's specific revenue bet doesn't land on schedule. Compute capacity is not sitting idle the way 1990s fiber capacity did, and the underlying scarcity driving these deals is real, not manufactured. Footnote 7. This isn't obviously a repeat of 2000. But the debt doesn't care about that distinction. A data center's specific SPV debt was underwritten against a specific tenant's specific lease payments. If that tenant's revenue trajectory doesn't survive contact with its own compute commitments, the physical building retains real value. The debt attached to it does not become any more forgiving because the underlying technology turned out to be useful in general. The 1990s fiber didn't just represent bad bets. It represented very real debt and very real bankruptcies, attached to infrastructure that later turned out to matter enormously. Worth is not the same thing as solvency, on the timeline that matters to a bondholder. One thing this episode has deliberately not done: turn this into a story about chip export controls or the broader US-China technology competition. That's a real, related, and significant story, but it's a geopolitical policy story, not a financial mechanism one, and folding it in here would dilute the actual argument. It's a strong candidate for its own episode later. The mechanism fits in one sentence. When the same small group of companies is financing, building, and buying from each other simultaneously, and financing the physical infrastructure with debt that doesn't appear on anyone's headline balance sheet, the system can look extraordinarily healthy for a long time, right up until one leg of it can't make a payment. Nobody in this episode did anything illegal. That's not a reassurance. It's the point. The 2008 financial crisis wasn't produced by widespread lawbreaking either. It was produced by a set of legal, well-disclosed, individually rational decisions that added up to something nobody had fully mapped until it broke. This series will be watching for the specific trigger. A stalled deal, a downgrade, a lease that doesn't get renewed, that turns this mechanism from a foundational story into a current one. When it happens, you'll already know exactly how the pieces connect.